Hello, everyone, and welcome back to Gold Off the Charts. A little deep financial thinking every day will help you see further, trade steadier, and outlast the rest on the road to building wealth. In today's video, we have to talk about the gold market, which has left countless investors feeling anxious and stressed over the last 2 days. If you've been watching the charts, your heart rate has definitely been spiking. Driven by a flight to safety, the gold market has hit a series of jaw-dropping highs over the past 48 hours. Prices didn't just break through resistance levels, they smashed them. It even surged to a record high of $4,600 in one fell swoop. Although we've seen some technical volatility after hitting that peak, the current price action remains incredibly resilient. Prices are holding steady near $4,600, refusing to drop significantly. It's like a giant standing on a cliffside, signaling to the world this rally is far from over. Faced with such a powerful and almost irrational market, I'm sure you all have two big questions on your minds. First, is this wave of risk-off sentiment triggered by geopolitics just a passing breeze? Or will it turn into a long-term storm? Can this momentum last? Will it intensify and push gold toward a crazy $5,000 mark? Second, now that the bull market trend is confirmed and even central banks are loading up, how do we actually play this? How do we find a good entry point? Should I FOMO in and buy right now, or wait for a pullback that might never come? Today, I'm using this deep dive video to break it all down. I'm going to peel back the layers and dismantle the logic behind this move. We'll start with Trump's complex global oil strategy and travel back to the wild gold rush of 1979. We will look for a historical mirror image to create a specific game plan for investors in 2026. This episode is packed with hardcore info, so I recommend finding a quiet spot and listening closely. First, let's look at the source. Why is gold suddenly going parabolic? As I mentioned in my last video, there is a clear trigger for this round. The immediate catalyst was Trump's aggressive maneuvers in Venezuela. But if you think Trump is mobilizing just to remove Maduro, you're being a bit naive. If you think it's just about Venezuela's oil reserves, you are underestimating the strategic vision of this real estate mogul turned president. We need to look past the surface. The U.S. plan for Venezuelan oil is actually just an intro, a stepping stone, or even a pawn. The real endgame for the United States right now, or the centerpiece of Trump's grand strategy, lies in the Middle East, specifically with Iran, a country that has been a thorn in America's side for decades. Why does Venezuela matter to Iran? It's all about the anti-U.S. oil alliance these two have built over the years. You might not know that Iran and Venezuela, both heavily sanctioned by the U.S., have spent years leaning on each other. They have huddled together for warmth, creating a deep bond of mutual interest. This isn't just a trade deal, they are survival allies. First, there is technical support. Venezuela has oil, but it's heavy crude, which is hard to refine without specific technology. Iran has been providing the refining expertise and the key chemicals needed. They help Venezuela process that heavy oil into something usable. Second, their trade is complementary. Iran sends gasoline to Venezuela via a massive shadow fleet of tankers. This allows them to swap resources and circumvent U.S. sanctions. There is also financial cooperation. Both are trying to ditch the U.S. dollar for local currencies. This is a direct attack on petrodollar hegemony. The Trump administration sees this partnership as a double threat, and he moved on Venezuela with two goals. First, topple Maduro to install a pro-U.S. government and cut off Iran's main ally in Latin America. Second, and more ruthlessly, shut down their shared oil trade channel. This prevents Iran from getting critical revenue through Venezuela, effectively starving his opponent. Now you see the big picture, right? Trump is playing a high-stakes game. The goal is to zero out Iran's oil exports and crash their economic foundation. What makes me both nervous and excited for gold bulls is how much this feels like history. The current climate in Iran bears a striking resemblance to the eve of the 1979 Islamic Revolution. What does the chaos in Iran look like right now? First, the economy is in a total meltdown. Under extreme U.S. pressure, the Iranian rial has become play money on the black market. Inflation has skyrocketed to nearly 50%. A lifetime of savings can lose half its value in a single month. High unemployment means young people can't even afford bread. This economic despair is the ultimate fuel for civil unrest. Second, and more dangerously, we see the social fabric tearing. Do you know how the Pahlavi dynasty fell in 1979? It wasn't a military coup, it was a strike by the Bazaris, the merchants. In Iran, these merchants are the backbone of society and the economy's lifeblood. Right now, businessmen in Tehran's Grand Bazaar have begun striking to protest taxes and currency failure. This is a carbon copy of the winter of 1978. Finally, there is a power vacuum. The supreme leader is aging, and the succession plan is a mystery. Hardliners and reformers are fighting behind the scenes. This kind of political instability often leads to a massive, uncontrollable black swan event. So, do you see it? A crashing currency, merchant strikes, and a power vacuum? It's 2026, but it feels exactly like 1978! History doesn't always repeat, but it often rhymes. That's why the gold market smells blood. Interestingly, 1979 was the launchpad for gold's last crazy bull run. It was an epic surge where gold went from $100 to over $800, creating the most famous gold mania in financial history. So, will history repeat? How similar is our current situation to the past? Let's turn the clock back 47 years to see how that drama unfolded. You'll find the details eerily familiar. In early 1978, gold in London was around $140. Turmoil began in Iran, and the prelude to the revolution was just starting. The market began worrying about oil production cuts. Gold prices started to climb. By December 1978, Iranian oil production dropped by 5 million barrels a day. This sparked the second oil crisis. Oil prices soared, and gold hit $244. In early 1979, the government changed, and Iran stopped oil exports for 60 days. The world panicked. People were waiting in long lines at gas stations. In November 1979, the famous hostage crisis broke out, and 52 hostages were held for 444 days. The US-Iran conflict escalated, and war felt imminent. Gold surged to $370. By late 1979, just when it seemed things couldn't get worse, the Soviet Union invaded Afghanistan. Cold War tensions exploded, and geopolitical shocks stacked up. Gold rushed past $500. Finally, in January 1980, amid total panic, gold peaked at an all-time high of $852. In just 2 years, it gained over 240%. Now, back to 2026, this gold rally is fueled by the awakening of these historical memories. U.S. oil ambitions aren't slowing down. As Trump tightens the noose on Iran, a further deterioration of the situation is almost inevitable. Combined with Trump's unpredictable style, this flight to safety is likely just getting started. The market is currently pricing in the expectation of a major conflict. However, as rational investors, we can't just blindly follow the past. While Iran's situation will drive gold higher, I have to be objective. 2026 might not see the same 8x increase we saw in 1979. There are 4 major differences between then and now that you need to understand. First, the core reasons are different. 1979 was an existential crisis. Inflation was eating wealth, the dollar was dying, and people bought gold just to survive. In 2026, it's more about asset allocation. Investors are using gold to diversify and add insurance to their portfolios, not out of pure, desperate panic. Second, the energy landscape has changed. This is huge. In 1979, Iran's exports were 10% of the global supply. Today, the U.S. is the world's top oil producer thanks to the shale revolution. Global supply is diversified, and OPEC Plus has plenty of extra capacity to fill any gaps. Even if Iran has issues, oil prices are unlikely to double like they did in 1979, which weakens the link between oil prices and gold inflation. Third, the market structure has shifted. 1979 was dominated by retail speculation and panic buying in a small, loosely regulated market. In 2026, institutional investors lead the way with ETFs and futures, making the market more rational. Fourth, and most critically, is the central banks. In 1979, central banks were mostly bystanders or even sellers. In 2026, they are the biggest buyers in the room. China, India, and Turkey are all loading up. They are hoarding gold, which provides a hard floor for prices. They act as an anchor that prevents a total crash, but they also keep the market from getting too wild. My core takeaway is that 2026 will be characterized by short-term spikes plus steady long-term growth, rather than a boom and bust cycle like 1979. We are facing a healthier, more durable bull market. So, given that gold is in a long-term uptrend, how should we actually buy in? In a market that is easy to rise, hard to fall, how do we find an entry? I know many of you are torn. Buy now and risk being stuck at $4,600? Or wait and risk missing the move to $5,000? I have two strategies for you, depending on your risk tolerance. If you are a swing trader looking for short-term gains, you must watch every Iran update and every Trump tweet like a hawk. Any news of new sanctions or military friction in the Persian Gulf is your buy window. At these moments, fear will spike the price. However, these are geopolitical pulses. They come and go quickly. Once the news cools down or the market gets used to the tension, prices often pull back. You must be flexible. Set your take profit and stop loss levels, don't get greedy, and exit once the initial hype fades to avoid the correction. Second, and my preferred method, is the long-term strategy. Since we know central banks are buying and de-dollarization is a trend, gold is your foundation. Gold should be the ballast stone of your portfolio. I recommend a 5% to 10% allocation for most investors. For this portion, don't sweat a $50 fluctuation or worry if the price is $4,600 or $4,550 today. Just hold it as a hedge against the dollar and black swans. In 2026, the best buying opportunities happen when the news cycle gets quiet. For example, when a crisis seems resolved and the world feels peaceful, or when U.S. economic data looks good and the dollar bounces, causing a gold dip. That is your chance to build your long-term position. Finally, a word of warning. Even though we are bullish, do not over-leverage. The perfect storm of 1979 is hard to replicate exactly. If you try to get rich overnight expecting gold to double in a month, you'll likely get shaken out by normal market volatility. Trump's oil strategy is backing Iran into a corner, providing plenty of fuel for gold. We see the shadows of 1979, but in a new financial era. U.S. ambition, Iran's crisis, central bank anxiety, and investor fear are all driving this ship into uncharted waters. View these events rationally. Seize the short-term spikes, but focus on the long-term value. Don't fall into the trap of buying high and selling low. Be a friend of time. Follow the lead of the central banks and use market dips to optimize your entry costs. Please remember, all this analysis is based on my personal analysis and current market data to help you cut through the noise of the news. This is not direct financial advice. That's it for today's deep dive. If these insights helped you see something you hadn't noticed before, let me know your thoughts in the comments. Don't forget to like and subscribe to Gold Off the Charts. See you in the next one.